The collapse of the Silicon Valley Bank shocked everyone. 4 banks have gone under within 2 weeks. What caused the collapse of the Silicon Valley Bank? Is the money that you're putting into your bank safe? We're going to discuss this today. What's up, guys? Today, we're going to talk about the collapse of the second largest bank in US history, Silicon Valley Bank, which had everyone talking over the last 2 weeks. Isn't it shocking that 4 banks collapsed so quickly in just 2 weeks? The number one question on everyone's mind must be, will the contagion spread to other countries? And is your money safe at your bank? Never underestimate what the depositors and investors can do to a bank. If they panicked and trigger a massive withdrawal of money, a bank can collapse quickly, just like the 4 banks. In Singapore, you can get back $75,000. This is because in Singapore, the local and some foreign banks are insured by SDIC, who pays up to $75,000 per customer in the event the insured bank folds up. There are a few critical elements that cause Silicon Valley Bank to collapse. If you have put in lots of money with your bank, perhaps it is time to take a closer look at the businesses. Number 1, does your bank have customers on fixed interest rate? This is one of the key reasons for the collapse of Silicon Valley Bank. The bank can make a profit from fixed interest rate paying customers as long as interest or deposit rates are lower than the fixed interest rate. Silicon Valley Bank had a lot of deposits from startup companies and had invested 48% or $91 billion of the investors' money in treasury and government-backed mortgage bonds. These are relatively safe assets and a prudent strategy. These assets were paying a fixed interest rate of 1.65% for a 10-year period, and the Fed rate was no more than 0.5% before the Ukraine-Russia war broke out. Silicon Valley Bank was sitting on a gross margin of more than 1%. Trouble came when the Ukraine-Russia war erupted in March last year, and the Fed rate doubled to 1%. By June last year, the Fed rate had increased to 1.75%. which means Silicon Valley Bank was in the red. Lo and behold, the Fed rate just kept creeping up to as high as 4.5%, and the potential loss ballooned to $17 billion. Market analysts expect the Fed to increase interest rates by another 3 to 4 times this year to curb the inflation in the US, which means the bank's losses could become even bigger. So the bank was forced to cut losses and sold some of the bonds. It lost to $1.8 billion. Greg Becker, the CEO, then announced the bank intended to raise $2.25 billion to beef up its capital on March the 8th. The news sent the depositors into a tailspin, and they were frantically trying to withdraw their money. The withdrawals reached $42 billion in a single day, and that was the nail in the coffin for Silicon Valley Bank. Think about it. If there is no panic from investors to withdraw their money, the bank could technically ride out the 10-year period and hope the Fed rate would come down. So have a look at how your bank is charging their customers for the loans. Are the interest rates on fixed or floating rates? Most banks in Singapore charge floating rates for the loans, which means they can pass on the higher rates to the customer. The question is, can the customers absorb the higher interest rate? Costs will increase for the businesses and stress the cash flow and profit levels. So the profit trends of your bank is another area you have to pay attention to. Number 2, if your bank has fixed rate assets, check out how the bank manages the rising interest rate risk. Banks typically hedge the risk. Silicon Valley Bank did not hedge the risk. It does not take a genius to know that if you only earn a fixed 1.65% on your assets and your borrowing costs could increase further, you will have to hedge against the increasing interest rate. But the management of Silicon Valley Bank took a risky position. It hedged less than 1% or $563 million of the $91 billion fixed rate bonds. In other words, the management practically did not hedge against the rising interest rate. This was a complete U-turn from the prudent risk management, because in April 2021, the CFO, Daniel Beck, told the investors that the bank had hedged $10 billion worth of bonds. The bank increased the hedges to more than $15.3 billion by the end of 2021, but decided to gamble with the investors' money and terminated most of the hedges throughout last year, taking the bet that the Fed rate would decline instead of protecting the investors' money. By the end of last year, Silicon Valley Bank reported $2.4 billion losses. 90% of the investors' money were not insured, and many would not be getting their money back. The management's reckless behavior caused massive losses and misery to the investors, which could have been avoided if the bank had hedged against rising interest rates. Number 3, watch out if your bank's CEO, executive directors, and senior management have been selling their shares in the bank within a short period of time. This is not a good sign. Think about it. Why would you want to sell the shares of a company if you believe in its potential growth? Wouldn't you want to hold on to the shares for further upside? People sell the shares of the company when they think that the company is not doing well, and share prices will fall. This is exactly what the management of Silicon Valley Bank did. The CEO sold 3.6 million worth of shares on February the 27th, just days before the bank collapsed. The CFO also sold 1/3 of his shares worth $575,000 on the same day. Doesn't it raise alarm bells? The CEO and CFO selling their shares on the same day. In fact, the CEO had sold nearly $30 million worth of shares over the last 2 years. The Chief Marketing Officer, Michelle Draper, and Chief Operating Officer, Philip Cox, also sold millions of dollars worth of shares for the last 2 years. All in all, the management cashed out $84 million worth of stock over the last 2 years. People tend not to pay much attention to the sales of the shares by the key management members, so do watch out for this red flag. Another warning sign that Silicon Valley Bank is in trouble is that its share prices had declined rapidly. Its share prices declined 66% last year. You might ask, what's so unusual about the decline in share prices? After all, the share prices of other banks have also declined. The critical question is, has its share prices declined much more than its peers? The answer is yes. The share prices of 2 of its peers, Bank of America and Comerica, had declined 31%. Less than half of Silicon Valley Bank's share price declined last year. So if the share price of your bank declines more than its peers, it could be a red flag. I hope you will find the critical factors that caused the collapse in Silicon Valley Bank helpful in understanding your bank's businesses better. These are by no means the only risk. Ultimately, the massive panic by the investors triggered a massive withdrawal of their money, which caused the collapse of Silicon Valley Bank, Signature Bank, Credit Suisse, and First Republic Bank. Fortunately for investors of Credit Suisse, UBS is the knight in shining armor and moved in to bail out the bank. The other banks were not as lucky. Please leave us a comment. If you like our video, please like, subscribe, and share.